for joining us for one of our executive pop-up webinar sessions. And this is a continuation of our conversations regarding the evolution of PPP, the $900 billion new stimulus. Today, again, we're bringing back our friends John Rizzo as well as Dan Matteo with RDG and Partners. And I am Tony D'Agostino, the founder and CEO of Inspire Care 360. And thank you all for joining. We are getting started right now, and let's go through the agenda. All right, let's move forward. Here we go. So we're going to go through a couple little items first. You'll see on your toolbar a Q&A section, as well as you will also recognize the opportunity to, when we send a recording out for this, as well as after this session, you can get a certificate if you are seeking one. Today we'll get into some quick housekeeping items, as well as talking a little bit about what are some of the events that are coming up in the near future. And speaking of events, let's talk about it. Our next event is going to be something that we're doing a little more unique than we haven't done in a while. And that is Walk the Line, is a presentation that Bevette Stodgill, our Vice President of Programs, as well as myself, will be presenting. This is a little unique as we're not interviewing someone else, but we're coming to you and talking to you about some of the must-haves in the world of how do you recruit and retain your staff. We're a huge believer in the next generation of children, and to get to that wonderful next generation of the care and support and education of those kids, that you need a very stable staff. And in this presentation, you will come to learn why staff decide to stay or leave in your organization and the real staff impact of the turnover, how it affects your business, as well as, for you as the owner operator, take control of the process and not just leave it to chance. And then on top of it, what we're going to do is have several walkaways, 9 to 10 different not walkaways, but 9 to 10 different takeaways that you will have that you can then work directly on within your schools and work on directly with your recruiting and the retention of your teams. So join us Tuesday, slightly later than this time, at 1:30 p.m. Eastern time. So let's move on forward. And there comes our little walk the line lady. But let's talk about IC 360 ECE Healthy Advantage. We have addressed this in the past a number of different times, but with the recent change that is occurring in our administration, the Affordable Care Act will be square and center. This program not only is highly affordable and flexible, but it meets the Affordable Care Act. Let's talk about some of the things that it does offer. We just talked about affordability. So from $11.50 for an individual teacher up to $90 for their entire family covers an awful lot. This gives them access to 5 different type of healthcare programs and also so many different type of voluntary programs too. It's very easy implemented. It has an online app, and there is an engagement enrollment specialist that supports you in this. So it takes away from the administrative costs that you may have. For the teacher, though, for your staff members who take advantage of this, you may want to have this as your only offering, or you may want to have this in addition to an existing major medical plan. But what it does is it gives highly competitive rates from $1 with no high deductible, either like $15 office visits or $15 specialist visits, $50 to go visit an urgent care, or to have any kind of lab work or the like done. So it has a lot of different benefits for the program rate. It also is very friendly. We've set this up specific for the ECE marketplace, specifically for childcare, Montessori schools and programs. So it really speaks the language that teachers and administration need to hear and seek to hear. And it is hopefully delivering ongoing value. Hopefully you trust us as your for being members of ours, being part of Inspire Care 360. Trust is one of our very first thoughts when we look at working with our membership, and it is very important to us. And we believe that we have a lot of the knowledge to deliver and bring to you a program that really meets the requirements. And again, With FTEs being at 50 or greater, there's a huge penalty for not meeting that requirement. And this program meets Part A of the Affordable Care Act, the expensive part of the Affordable Care Act. But to learn more, please reach out to us. Here's just a quick summary. We've had over 20 companies join us so far that are now taking advantage of Healthy Advantage. And it does take a little bit of runway to get on board with this. That means from 1.5 to 2 months time frame from the time you say, yes, I'd like to move forward, to the time you actually can roll it out to your staff. With that said, please reach out to us if it is something you'd like to learn more about. Now let's talk a little bit about IC360 ECE financial experts. Today we'll be talking with John and Dan, and they are our partners for financial experts too. In their program that they do with us, they've created programs that really focus and support their years of experience within the child care industry and really look at some of the key indicators from industry to peer, and then different elements on your P&L as well as your balance sheet. And it is a program that we've now had a number of different people take advantage of, getting reports that show green, you're doing good, yellow, there's area for you to make some changes, and red, there's some immediate opportunities that you need to focus on because you might be losing significant dollars so far. So it is a real opportunity, and it more than pays for itself. So far to date, we've had 6 new companies have joined us since we just rolled this out before the holidays. And there is including a free financial assessment by the team. They will come in and take a cursory overlook of your information and give you that report to tell you where they can actually help you even before you make any level of investment. And again, please reach out to us, as that is a way for us to be knowledgeable as to what we can do to help you. So with that said, let's move a little bit forward here, and we're going to talk to John as well as Dan, and we're going to ask those guys to come online for a moment in just a moment here and get started. They are partners at RDG Plus. So gentlemen, welcome.
Welcome back, everybody. Glad to see all these people joining on here. Lots of familiar faces. Some people keeping up that perfect attendance streak. So good to see you all and good to be back. We didn't know what to do with ourselves without, some PPP webinars and stuff going on. So finally have something to do around here. So welcome back to the Hustle Firm presents the Stay Strong webinar series, PPP Take 2. All right, and as usual, you've got John Rizzo, CPA, and myself, Dan Matteo, ready to dive into this legislation, this massive piece of legislation. For technology things, we appreciate all the fun chats that you guys have been piping in here. We'll try to get back to you as fast as we can. But for any real questions, feel free to put that in the Q&A. We've got our research team behind the scenes. If you have any issues, if you can't hear us, throw that in the chat. Shelby will take care of that behind the scenes. And as always, we'll get a recording and these slides out shortly after we're done. So the agenda today, we're going to do a little news review, as we always do. We'll keep that brief. A tax update, which is obviously the most relevant thing with a couple days left in the calendar year, and PPP second draw loans. So this is huge, lots of stimulus, and then there's even more stimulus. So we'll dive into some of the more relevant ones. And obviously we'll bring you all of them in the coming weeks. And then obviously Q&A, we'll be answering those as we go. As I mentioned, we've got Ryan Lynn, we've got Chris, we've got Tim, all behind the scenes with John and I answering questions today. So if we don't get to it throughout the presentation, we'll get to it at the end. So thanks everyone for attending. We hope everyone is staying safe and healthy. The numbers are pretty staggering around here. So hopefully everybody's immediate friends and family and everybody around them are staying safe and healthy. We hope that continues through the winter. And again, huge thanks to our research team. We've been expanding resources over here. So we've got Shelby back. We've got all the people behind the scenes answering questions and making us look good on these webinars, because we certainly couldn't do it all by ourselves. So to get started, a little news review. what's been happening, and John's favorite medium is Twitter, so we always like to start there. So we've got our major players. Everybody knows these people. We've got Steve Mnuchin from the Treasury, Jovita Carranza, SBA, Mitch McConnell's been big, Nancy Pelosi, you've seen her name, Donald Trump, obviously, and then we've got some new players in here. We've got Timothy Hearn, I think. He's definitely one of those players. He's the Worm, his Twitter handle, if you want to follow him. So he's been in the news a lot. And then we have Johnny Riz, I think, down there. He's been one of the other significant players, really pushing the needle on the news feeds here on the TV waves. So we'll be hearing from him, seeing what he's been up to. So to dive in, we've got Mitch. So after the CARES Act kind of ended and we did all our wind down back in early June, they were already working on CARES 2, right? So this has been going on since June. They've been arguing back and forth. You've got McConnell in the Senate trying to put their HEALS Act together, which was actually a conglomeration of multiple bills. Then you had the House doing the HEROES Act. So that was Nancy Pelosi. We've got some of her tweets here. They were kind of going back and forth, right? Couldn't agree. It was $3 trillion from the Democrats. We had less than $1 trillion from the Republicans. And they just kind of kept going back and forth. They could agree on some things. They could not agree on others. Steve Mnuchin was kind of the quarterback, trying to play broker between the two chambers. And finally, they've strung something together here, which has really been a culmination of multiple bills. And we'll be highlighting that, of the fact that this wasn't really written overnight. It's been written over months, and they've just been negotiating key points. And then, here's Tim Hearn. He was in the RBJ the other day, so we got a huge press release from him. He was putting out some of the most important things, really short and succinct, nice summary from him. So shout out to Tim Hearn for being top of the news cycle in print. And then you had, your very own John Rizzo here on News 8. He was talking about this coronavirus relief bill. So they've really been pushing the news. If you haven't already heard from them, but looking good, guys. Very good there. So the Consolidated Appropriations Act of 2021. This was actually two bills. It's the budget, which is $1.4 trillion of this package for the next fiscal year for the United States government. And buried within there are multiple provisions for coronavirus relief, which is being called CARES Act 2. So while it was introduced, the legislation kind of came out in drips and drabs around 2 p.m. on 12/21. It was passed by the House shortly thereafter. People wondered how they could read so fast, but really it's a culmination of multiple bills being crafted over a number of different months. It quickly passed the Senate that night around 11:45 for those of you that were watching C-SPAN. And then the president, we saw some delays there over the stimulus checks, but it finally got signed on Sunday night. So this is official, House Resolution 133. So it's a mammoth bill, lots of different sections, lots of different titles to talk about. And you've seen some of the headlines, right, of, aid going to these foreign countries. That's the budget. So that is the Consolidated Appropriations Act. Buried within the budget of the United States government are two provisions. That's Division N and Division EE. First one being the additional coronavirus relief or response and relief division. That's all about the stimulus checks. It's about pandemic unemployment assistance, PPP round 2, and then Taxpayer Certainty and Disaster Tax Relief Act. So that's all of the tax extenders that typically come out in December, as well as the big announcement, which we'll dive into very quickly. So it was 9,953 pages, this bill. So obviously we read every single one of them, but a lot of you are like, how big is 9,953 pages? Well, to put it into perspective, I put some real life images up here. So this is John Rizzo, actually how tall he is. And then if you put him next to me, this is about how tall I am. And then if you put 9,953 pages of paper next to that, that's how big this bill is. So it's huge. I mean, it's even bigger than me, definitely bigger than John. So it's a big bill, lots to get through, and we'll be diving into some of the relevant sections today. So tax update. The first thing, obviously the big thing everybody's been talking about is PPP taxability. So when the CARES Act came out, the income was not taxable. Everyone heralded that. Okay, free money, it's truly free money. But then the expenses, everyone started talking about the expenses. Are they deductible or are they not? And there was precedent for the government and the IRS saying any expenses that you pay for with tax-free money are not deductible. That was Internal Revenue Code 265. There was case law on it. That's those two cases in the middle on the right-hand side of the screen. So the IRS came out with a notice and said, nope, those expenses are not deductible. And as a result, everyone kind of went into panic because now they had to pay tax on all this money that they weren't planning to. So over the ensuing months, we saw some bills. We saw Senate Bill 3612, and we said to ourselves, okay, this is good progress. Maybe it won't, maybe the expenses will be deductible. Maybe they won't. It never passed. It was introduced in the Senate, but never passed. So they were leaning towards that. And finally, in the new actual House resolution, the Taxpayer Certainty Act that came out, expenses are finally deductible. So hopefully you've been working with us, and we've been updating tax plans and running two scenarios for you, a best case, worst case scenario. But at this point, the income's not taxable, and all of those expenses that you use the PP money to pay for are deductible. So this is huge. Big news, big win for businesses. So if you remember, kind of pulled out a clip here from June 4th of 2020. We had talked about this. We said, hey, look, it's not passing, but this has been a long time in the works. Back in June, we talked about it, and finally it came true. Our wishes came true, Christmas miracle. So the similarities between the bill that we talked about in June it's almost exact. So again, this legislation has been months in the making. The bill was already introduced way back when. If you look at the actual bill text, the House Resolution Consolidated Appropriations Act, compare that to with the bill that was introduced back in June, it basically says, no deduction shall be denied or reduced, no tax attribute shall be reduced, and no basis increase shall be denied by reason of the exclusion from gross income. So all that to say, the income is tax-free and the expenses are deductible. Huge win, and a huge reminder to everybody that you should definitely be thinking about if there's any moves before the end of the year. Make sure you don't go too overboard with that. That's why we've been kind of running each scenario for people to make sure that we don't overshoot on deductions this year. Some of the other significant tax provisions, some were changed and some were extended. So the most important thing is, while the IRS says that the income is tax exempt and the IRS says that the expenses are now deductible, the states are decoupling from the IRS. And what that means is New York State, for example, is not allowing you to deduct the expenses, making the PPP taxable. So when you're going through your plan, as you're working with us, or as you're thinking about this for year end, while it's tax-free at the federal level, you might be paying New York State tax on that money, or whatever state tax. You have to go state by state. So for example, in New York State, that could be 6.5% to 7.5% on that money. So just be prepared for that. Another big win in this legislation, which was really seen as a hope to boost the restaurant industry, is that meals are now 100% deductible. So in the past, when you'd go out to lunch, take your clients, take your prospects, take your staff, those meals were 50% deductible. So you couldn't deduct the entire cost of the meal. Now you can deduct 100% of the cost of the meal through January 1st of 2023. So you have 2 years to go out to lunch, drink your martinis, and deduct the full cost. You also got charity for non-itemizers. So for all those people that are benefiting from the increased standard deduction, you can't write off your charity. However, with this new bill, you can. So you can write off $300 if you're single, $600 for married filing joint taxpayers of deductions to charity. So if you have not contributed to charity by the end of, by today, make sure, if you're a charitable person, donate to charity, and you can write off up to $300 or $600. Mortgage insurance premiums, for anybody that have those are still deductible. Those were slated to actually go away, so that's been extended. And then you have, for medical expenses, we were set to have a 10% floor that reverted back to 7.5%. So now we have a 7.5% floor, meaning if you have significant medical procedures or expenses, you may be able to deduct those depending on your income. As with anything, as you're going through these, the best thing to do is to contact our tax department. We can go through these plans, we can update these plans, we can tell you, are there anything that you need to do in the next couple of days, if we haven't already talked about it, to make sure you're taking advantage of all these provisions. I'd be remiss not to remind everybody about the CARES Act tax changes. So again, I'm just 30 seconds here on the 4 main changes that happened in the CARES Act. So if we have not gone through this with you, it'd be a great idea to reach out. Those 4 changes are: number 1, NOLs. So previously you could not carry under the old tax law that changed in 2017, you could not carry back NOLs. Now you can. So you can change that. You can carry those back for 5 years. So real estate people, that's why you see a lot of cost segregations. We can now grab some of those. We can take anybody who bought a business this year, for example, carry back losses. So you're able to deduct NOLs going backwards. And you previously, before the CARES Act, you could only offset 80% of your income. Now you can offset 100% of your income. So NOLs are huge. So important to tax plan around that. Previously, you could not deduct all of your interest expense. So the CARES Act ups that from 30% now to 50% of adjusted taxable income. So it's important here, not to get into the nuances of this again, but if you had a business with significant interest expense, you want to make sure you're planning for the fact that you can now write off 50% of your income with interest. Qualified improvement property is any improvement to a non-residential property. So if you have a commercial building, for example, you want to add a room, update the floors, any significant improvements to a commercial building, those are now deductible 100% for bonus depreciation. So those are important. And then excess business losses. So if you had losses carrying forward from previous years, you could only offset your current year income up to a certain amount. The CARES Act changed that. Now you can offset all of your income with business losses from prior years. So when you're doing planning, if you have NOLs, if you have excess business losses, business interest expense, or qualified improvement property, it's important to know the impact of that on your 2020 tax return. All right, so now I'm going to kick it over to John for the more exciting part of the program, PPP second draw loans.
Awesome. Thanks, Dan. It's good to see you. It's been, 6 months since we've seen each other for these webinars. So notice you worked hard on your hair and your beard, and maybe you'll get some votes for the best beard this time.
Yeah, actually, speaking of that, John, Shelby, could you launch that poll now? Because I think this would be a good poll to have. Is actually, I've been getting a lot of people asking me these questions of like, Dan, why did you not win the best beard contest the first time? I don't know. So if you guys want to, set the record straight once and for all of who has the better beard, John's been, hard to get through doorways. It's been, he's been walking around here with a, beard trimmer every day. So set the record straight. All right, Shelby, I think we can end the polling. I think we have enough there. Yeah, that's what I thought. We could share results.
It wasn't a complete
63%. That's what I thought. That's more like it, what I thought from the first time. So I appreciate everybody weighing in on that poll. That's final determination. Thank you, everybody.
All right, we're one and one. I'll give you that victory, but we're 1 and 1. All right, great. So PPP2. So again, who would have thought we'd be here still, 9 months after this whole pandemic started, and we're talking about a second round of PPP, $3 trillion in stimulus now. It's crazy, and we're on top of it. So let's get into PPP2. Before we get started, we do have another poll here that we'll have Shelby launch. And it relates to, we just want to see where everybody stands as far as their applications in the initial round of forgiveness. So we'll launch this poll here. So has your round 1 PPP loan been forgiven? Yes. My application is submitted but not approved yet. I have not applied for loan forgiveness yet. I did not receive a round 1 PPP loan. So we'll go ahead and launch that and give people time to answer it.
Awesome.
All right. So let's take a look. So yeah, based on the results, so we have quite a few that have already been forgiven. About a third of the people have already been forgiven, which is great. There is some strategy there. Then we have another third where the applications have already been submitted, and then we have others that haven't applied yet. So you do have plenty of time to apply still. But thanks for doing that. So we have a better understanding where everybody stands. All right, so PPP2. All right, so the similarities. So this legislation was actually drafted back in June. It just was never became final and official. So as you can see, there's you know, the one big change that they made to this was they added expenses. So now, and we'll go through this, the expenses that qualified before, they've expanded that. And they also back then were looking at a revenue decline of 50%, which they've now dropped to 25%. So there's some wins between June when this initially was drafted and now between these two bills. All right, so we're gonna do a comparison here of, let's say, PPP1, which we call old, and PPP2, which is the new. So number one, the funding. If you remember, PPP1 actually had 2 rounds, and it was a mad dash really for the first round. It only lasted less than 2 weeks, and that money was gone. It was a little over $300 billion, and they added another $300+ billion on top of it, and actually didn't even get through all the money. There was $100 billion or so left over, but overall, they appropriated $642 billion to PPP1, where now we have $284 billion additional for PPP2. There's a company size threshold. So in the old PPP, it was 500 employees or less. Now in the new, it's 300 employees or less. So they're reducing the company size here as far as eligibility. Impact. So before, this was open to any business really, and there wasn't a revenue decline threshold. Now you have to show a 25% or more decline in revenue in any given quarter of this year compared to the same quarter of last year. And then maximum loan amount. So the max loan amount under the old PPP was 10 million. Now it's dropped down to 2 million. So you can see that they're focusing more on smaller business. Accommodation industry. So this is new under the new PPP. Under the old rule, every company was 2.5 times your average monthly payroll. And now it's 3.5 times for accommodation industries like hotels and restaurants. Mainly restaurants here will benefit now by having their loans, the loan sizes will be larger. Payroll periods. So under the old, there were mainly 2 specific periods you could pick for your loan period to determine your payroll amount. So it was February 15th through June, or January and February of this year. Under the new, you can use all of 2019's average payroll or the last 12 months before your loan application. So a lot more simpler, a lot more flexibility, and should get you more of a truer average than just picking these 2 specific periods like they did round 1. Covered costs, like I said, these would be expanded. So under the old, it was payroll, rent, utilities, health insurance, and retirement. Under the new, it's all the old ones, plus other insurances, software, cloud, computing costs. So this is mainly like we're talking on Zoom and people are working remote. There were costs that companies had to incur now to, set up a remote environment. Property damage, this is more around the protesting. So if you're, say, a retail business that had damage to your property, you can include those costs. And then other worker protection like PPE, masks and gloves, and all the temperature checking and things like that because of COVID. Here's another big win, the EIDL advance. So under the first PPP, the EIDL advance was required to be repaid if you received a PPP loan. Now that's forgiven. And it's actually forgiven from all those that received it the first time around. So there is, you have to do some research and dig into if you already paid back your $10,000 and your loan was forgiven, then you need to contact the SBA and determine how that money would come back to you. And then another big one is employer retention credit. So if you received a PPP loan under the first loan, the employer retention credit was not allowed under the old. Now it is allowed under the new, and that's $7,000 per employee. So it's 70% of the first $10,000 that you pay to an employee, you're eligible for a credit. I'll let you go through more of those details on a future slide here. All right, so before we get into the highlights, we do have another poll that we will launch. We'll have Shelby send that next poll. Okay, did your sales decline by 25% or more during any quarter during 2020? Here we're trying to determine how many businesses actually will be eligible for this next round of funding, knowing that it's less funding than the first round. Give it one more minute.
Awesome.
All right, let's close out that poll. So looking at the results of that poll, as we expected, almost 80% of you had a decline in revenue. So that means 80% of you most likely will qualify. There are more details to come out about this. However, this is good news, at least for those that are on the call that may qualify for PPP number 2. All right, so let's dig into the highlights of the program. And this is high level because, as you know from PPP 1, things change when the application comes out. Guidance continues to come out almost on a weekly basis. This is what we know today after reading through the bill. So the program highlights, $284 billion is allocated. Forgivable loans for the first, these are forgivable loans for first and second time borrowers. So same as the first round, the second round are forgivable loans as well, as long as you use the funds for these qualifying expenses. The list of qualifying expenses, like we said, expanded from PPP round 1. We showed you all the new items that you have there to add to the list. So you're not limited to just payroll or retirement or health insurance or your rent or utilities. Now, what we found in round 1, because they allowed you to expand your time period from 8 to 24 weeks, that most of our clients used all of the money on payroll. And that was the simplest way to do your forgiveness application. There is a simplified loan application now for loans that are $150,000 or under. We were hoping this would come in with PPP 1. It didn't. The simplified application under PPP 1 were for loans of $50,000 and under. Now they've increased that to $150,000, and we're hearing that that will more or less be a one-page certification. So the information you need to gather and the submission you need to make to apply for this loan should go quicker if your loan's 150 or under, and it won't bog down the banks as much as these applications start coming in. Other qualifications are number of employees. So 300 employees or less, that's down from 500. So again, the focus on smaller businesses. We didn't see that this was too much of an issue with some of our clients, but it is down to 300 employees. There are some other exceptions there, like the alternative rule for companies that are over 500. There actually are tangible net worth and average net income qualifications that may allow someone that's over 300 employees to still qualify. And we actually covered this on PPP round 1. I'm sure we'll cover it more again as we do future webinars. 25% revenue reduction in any 2020 quarter compared to the same quarter in 2019. So this is big. I talked to a client actually before this webinar started, and essentially if they have revenue delayed in these last couple of days of the year, they would hit this 25%. If they can't delay revenue for whatever reason, then they wouldn't hit this 25%. Now, there's more rules that come out about this. I'd really be very surprised if you are down, if you are up for the year, but down for a specific quarter, that they will still allow you to qualify. Now, the way it reads right now, that if you're down for any quarter of the year, and it doesn't even specify whether it's a calendar quarter or any 3 consecutive months, it'd be hard for me to believe that if you're down for one quarter, but you're up, say, 20 or 30% for the year, that it still allow you to qualify. But we'll see. That will be in the fine print of the loan application and further guidance when that eventually comes out.
Yeah, and one of the good points on that is they're going to continue to require the necessity checkbox. Although on the first application, when you checked it, if your loan was under $2.5 million, the SBA came out with guidance and said, look, if you check the box in good faith, we're not going to audit you on whether or not you needed the loan. On round 2, we can strongly suggest that they're going to look at that if you needed the loan. So like John said, if you might be down for a quarter, but if you're having the best year of your life, you don't need that loan for round 2, they're going to look at that. So we've seen some of the checklists on how they're auditing loans that are over $2.5 million. And one of the most significant sections of that checklist is, did you or did you not need the loan? So we can fully expect that for round 2, that's one of the things you want to go through. Doesn't mean you should shy away from it. It's just if you're having the best year ever, you might want to look pretty carefully on how you're going to document that you need this loan for round 2.
Yeah, the other item we've seen them look at in audits is owner compensation. So in all forms of owner compensation, not just wages and draws, but where other dollars are coming out to the owner. So we know they're focused on those areas like they usually would be. The other qualification is that you must have used all the PPP 1 funds. to qualify for PPP2. All right, so the amount, $2 million is now the max, down from $10 million. But if you actually look at the number of loans that were issued under PPP1, the majority of them were under $2 million. It was something like over 95% were under $2 million. So another reason why they probably dropped this down from a 10 million max to a 2 million max. Actually, right here, 98.5% was under 2 million. Loan amount, like I said, is 2 times your average monthly payroll, 2.5 times, 3.5 times for food and accommodation industry. So that would be a big, big help to our hotels and our restaurants, our catering companies. And for payroll, you can use the 2019 average monthly or the 12-month average, the rolling 12-month average prior to your loan, applying for your loan.
So for a lot of you, this is going to be almost exactly the same amount as you had for your round 1 loan.
Yeah, and most likely you'd use your 2019 numbers because the pandemic wasn't occurring then. You maybe didn't have, you've had some months here maybe where not everyone was fully employed. Covered costs, so like round 1, payroll, health insurance, rent, retirement, utilities. And here's the new items: vision, dental, group life, and disability insurances, software and cloud computing, like I said, like Zoom subscriptions, property damage costs, certain supplier costs, and worker protection PPE related items. You do now have flexibility with your covered period. So if you remember from round 1, the initial covered period was 8 weeks, which is very tricky trying to figure out how you could use, 2.5 months of payroll in 8 weeks, right? So of course they got smart and expanded that to up to 24 weeks. Now they're telling you it could be anywhere in between 8 and 24 weeks. Once you've spent the money, if you spend it after 10 weeks, you'd stop after 10 weeks and apply for forgiveness at that point. If it's 12 weeks or whatever the number of weeks it takes you to spend these dollars, that's the period you would pick, as long as it's not more than 24. 1 paid certification for loans under 150, we talked about that. And this is big, you can actually reapply for additional funds if you missed items in round 1. We've had some clients that submitted their loan application and forgot certain items like retirement or healthcare, utilities or rent, or didn't capture every employee, or put too much of a limit on owner's pay. We've seen all of it at this point. So you can actually go back and reapply for more money if you made calculation errors the first time around.
All right, so that's PPP second draw loans. Obviously, lots more to come on that. Some of the questions that have been rolling in, we've been looking at these and answering these. Banks are not accepting these applications yet. They, it was just signed into law on Sunday. So we're anticipating hopefully a very quick turnaround. It's obviously very needed for many of you. So we're hoping that with the 1-page form, the Treasury Department and the SBA are going to come out and say, hey, it's a 1-page form, certify, check here, and we'll go. One thing that I was reading in the bill is that supposedly, if your loan is under 150, so there's a simplified application, all you have to do initially is certify, yes, my revenue was down 25%. Yes, I need this loan. How much was your first round loan? And it's 2.5 times your monthly costs. So that should be as easy as it is. On the back end, when you apply for forgiveness, you'll have to submit all the documentation. So they're trying not to hold up the money getting in businesses' hands and have you prove it on the back end when this all comes out. So hopefully those are the loans that are going to be open very quickly, but we will know more when Treasury issues its first guidance. Right now, banks don't have any guidance, nobody has any guidance, so no loans are being accepted. All right, so for more stimulus as we're going through, the first big one is the employee retention credit. So John touched on this, he's going to kind of dive in a little bit more.
Yeah, so this is a big credit and it's big dollars. So basically 70% of wages up to a $7,000 credit. So the first $10,000 you pay employees, and there are qualifications, you will receive up to $7,000 credit for those individuals. So that's real money. If you have 10 employees, that's $70,000. 10 employees you pay at least $10,000 to. So some of the qualifications: your company was shut down or your revenue dropped by 20% or more. Okay, so that's number one. And then as we saw, 90% of the people on this call had a drop in revenue of 25% or more. So you can check that box. The credit is for wages through next year. So through next June, you can look at wages and look at this $10,000 maximum times 70%. So you have time here to capture this credit. And one thing is you can't pay wages with the PPP money and count those wages towards this credit. This is why this credit wasn't allowed the first time around. So basically what you would do is utilize your PPP money. Now there are strategies here, like you could bonus employees. If you're planning on bonuses anyways, use up that PPP money as fast as you can, and then have remaining payroll dollars left, just like the first round of PPP. You're going to continue to obviously pay your employees once the PPP money is gone. Utilize dollars after the PPP is gone and apply for this employee retention credit. So this credit, most of you should qualify for this, and it's real money. And you apply for it actually on your payroll tax return, your quarterly payroll tax return. So it's not done through your income tax, it's done through your payroll tax. You want to sync up with your payroll provider to be able to capture this credit. Here's some strategies like I mentioned. So you want to use all the non-payroll costs for PPP. So now we have a longer list of costs that qualify for PPP. So now we would tell you to use as many of those as you can, knowing that you could also grab this other credit, right? Focus on the software costs and the rent and the utilities and a lot of the non-payroll stuff, and maybe save some of your payroll dollars for the credit. Pay employee bonuses to use the PPP funds and then apply for the credit, like I mentioned before. And then consider retroactively applying and delaying the PPP forgiveness to use more than non-payroll costs. So it really depends on your situation what to do here with this last bullet. You know, a lot of people are very anxious to get their loan forgiven, but don't be too anxious where you miss out on other opportunities. Now that we know it's not taxable, that anxiety kind of goes away and you can apply for it. However, you may miss out on things like this. You really need to sit down and strategize to decide how you want to handle the use of the PPP money as it deals with taxes. Now that the PPP isn't taxable, you may want to add some income in the last couple of days of the year. If you thought the PPP would be taxable for you and your loan was $200,000, now you have $200,000 less in taxable income. Maybe based on your situation, you can afford to convert an IRA, to a Roth IRA, taking some income, and you still end up in a good tax position. Also keeping in mind that tax rates are most likely going to change over the next couple of years. So there's a lot of strategy here, not just with this credit, but your overall tax situation.
All right, so we've got that. Employee retention credit, probably the biggest one. John touched on the second bullet point here, which is the EIDL does not reduce the PPP loan forgiveness. So again, going back to the EIDL, there's two components to the economic injury disaster loans. There's an advance, which was up to $10,000. A lot of you got 1, 5, 7, 10. It was based on the number of employees, we found out later. So there was that advance, and then there was the loan. And a lot of you got up to $150,000. That was that artificial cap. The advance up to 10 grand used to reduce the PPP loan forgiveness. So essentially, if you got PPP and an advance, you had to pay back the advance. Now that EIDL is not repayable. So if you took that advance, then you don't have to pay that back. If you already paid it back, there will be a mechanism that they will send that money back to you, presumably. Or in PPP2, you'll get more of a loan. So they're working on that. If you didn't get the EIDL program is not over. It's changed. It's changed quite significantly. More of it's going to harder hit areas, but the EIDL program is still open. So there's still an opportunity there. So lots of planning around there, but again, this is found money. This money is also not taxable, just like the PPP loan. So that could be, significant for some people. Small business debt relief. So for those businesses that have a 7A loan, a 504 loan, or a micro loan, all of those are loans that would have been taken out through the SBA. And typically, you're getting an SBA loan when there's a collateral shortfall, when it's a difficult business concept. You know, these are more and more common because they're guaranteed by the SBA and the banks like them better. So those loans, for the people that have them, will get an additional 6 months. If you had one of those loans, you got 6 months paid for already, up to $9,000 per month. If your loan payment is more than $9,000 a month on one of these loans, what they do is they pay your loan for 6 months for the full amount, and the difference between the full amount and $9,000 gets added as interest expense to the end of your loan. They also are extending pandemic unemployment assistance, so that's the $300 that's coming out, so that'll mainly impact individuals. A reminder, I'm sure this is going to come out again in the next round. If you have an employee that's on unemployment and you offer them a job to come back, and they say no, it will most likely be your responsibility to notify the unemployment office that they said no. That will then mean that it doesn't count against you that you had a reduction in your workforce. So that was there in PPP 1. It'll most likely be there, that's my prediction, and it'll be there in round 2. And then the economic impact payments, this is obviously mostly individuals, $600 per taxpayer plus an additional $600 per dependent, up to $2,400 per household. And maybe it'll be increasing to $2,000. A lot of you saw yesterday the CASH Act, and I forget the acronym, but it was clever. Increasing the $600 to $2,000. It passed the House. It did not pass the Senate, and it has not been signed into law by the president. It was blocked for a vote in the Senate, so we're still not sure the fate of this bill at this particular time. All right, so there's tons more tax goodies, there's tons more stimulus, lots of different nuances. This is just meant to be that first initial high-level item. So we'll kind of go to the Q&A. We've answered 26 or so questions so far, but let's get to some of these questions. The first one, I'll take the first one. Has gross receipts been defined? Charities have multiple revenue sources. So the answer to that is no. I've not dove into that yet. It may be in the bill. We haven't gotten that far, but obviously more guidance is going to come out shortly on that one.
Yeah, same thing with another revenue-related question for not-for-profits. You know, what is considered revenue? What is considered income? We're assuming, again, this hasn't been clarified at all, but whatever you normally report as your income would be included. So in the case of a not-for-profit, it probably would include any sort of investment income, but we don't know for sure yet. We really can't answer that question completely.
All right, we've got another one here from John. So he said we have 3 separate entities, all payroll runs through one, no issues in the first round. I agree. We had lots of clients in this situation with holding companies, etc. Second round is based on revenue, and that's true. If you have a 25% drop in revenue, that's the first qualification hurdle that you have to get over. And if only 1 or 2 of those entities had a drop in revenue, how do you deal with that? We don't know the answer to that. I'm assuming that's going to be in one of those interim final rules. If you remember, there was like 1 million of them that came out every other day. My guess is we'll have to navigate that with the SBA and through those interim final rules to get some clarification.
All right, another question. Look at our guy, as we're getting ready to answer questions, our geeks behind the scene are answering questions. Love that. On top of it. Let me see. All right. So is there a limit of the retention credit in total? The credit's up to $7,000 per employee. Can the PPP loan cover the payroll over $7,000? Yes, the PPP can cover payroll over the 7, but again, like I talked about before, timing is important. So if you can't use the same payroll dollars for the credit and for the PPP. So you got to be careful. If you pay an employee $20,000 and then you want to make sure 10,000 of it was the PPP money you used, the other 10 you would use for the credit. So again, there's some planning there. You just don't want to all of a sudden start to pay people and not have a plan here.
All right, we got another one from good friend here, Andrew Claus. He's in construction here. So how long do you have to be shut down? We had a couple of construction, some jobs were shut down, employees were forced to sit. We don't know the answer to that yet. Again, one of those questions that they didn't really get into the nitty gritty. I'm assuming that interim final rules are going to come out and we'll know more about that. But as with anything, there's going to be some things that are very nuanced and other things that are very broad. So obviously, we just want to make decisions based on the broadest interpretation possible. And if we have to narrow that, we will. But, you know, I would suggest we kind of work together on that one and just say, hey, let's prepare the application and hopefully we can get this employee retention credit.
We have a question here coming in on if the loan application is actually through the government or your bank. It would be through your bank. So PPP1, everything was processed through the bank. So you want to, the bank's not going to be able to give you any answers right now, like Dan had mentioned. So I'm sure we have some bankers on the call, and they're probably going to say, hey, don't call us yet. The application isn't even out. So once the application comes out and we know when the funding will officially be available, each bank will come out with their process like they did the first time. Some did online-only applications. Others did everything by paper. So you want to be ready to contact your bank. But we anticipate that the money will move a little slower this time because the pool of applicants will be smaller. It's smaller businesses. Not everybody qualifies based on their size. So.
All right, everybody. Well, look, this has been a lot of fun for us, as always. We've answered, hopefully, some of your questions today. More will be coming out soon, and obviously, we'll jump on it as soon as we can. We'll stick around for a couple minutes here if any questions roll in. But obviously, contact any member of your team. We've all been working hard on this new legislation, especially as we head into busy season here. So I'm sure we'll be talking to a lot of you. And just reach out to any member of your team. We'll get those questions answered as soon as we can. And hopefully we'll see you soon. As always, the message is, John, I think.
Stay strong. We'll see you in the playoffs. 2020 wouldn't be 2020 without the Buffalo Bills winning the AFC East for the first time in 25 years. They have an MVP candidate, and no fans can even go watch them play. So go Bills.
Go Bills.